So we're talking about the different areas of the Federal Reserve, right? The Federal Reserve regional banks, the Board of Governors, and the infamous FOMC. Okay, so the first one that we want to talk about is Federal Reserve regional banks. Okay, we know that there are 12 regional banks. Okay, why 12? There's an interesting discussion about that, right? But why is there 12? There's a few reasons, right? I will say that one of the interesting parts about the history of this is to sell this, they wanted to make sure that other parts of the country outside of DC and New York and Chicago and San Francisco, those are the big economic hubs, that everyone in the United States would have some amount of representation, right? That it wasn't just going to be New York City, it wasn't just going to be the political power in Washington, someone in Kentucky, someone in Minnesota. Their economic problems would be reflected in the monetary decisions of this new system, right? This Fed. So they established a bunch of regional banks. Right? Why 12? Some people say because of the 12 tribes of Israel, being this religious connotation. Maybe, but it kind of works out. If you look at the map of where they are, a lot of them tend to be where we would expect, in the northeastern quarter of the United States. And then as you move out towards the west, where there is fewer people, you see fewer regional banks, right? So what are those 12 banks? Well, we have Boston. We, of course, have New York City, and we're going to put an asterisk next to the New York City Fed because it is a bit different, right? While all federal regional banks are equal, some regional banks are more equal than others, to quote badly George Orwell. Philadelphia, of course. We have Richmond, Virginia. We have Atlanta. I'm forgetting one. Oh, of course, Chicago. We're going to put another star next to Chicago because there's something interesting about the Chicago Fed as well. We have St. Louis. We have Minneapolis. I always forget how to spell it. Kansas City, in Kansas, not Missouri, but we have Kansas City. San Francisco. We are also going to put another asterisk next to San Francisco. Dallas. And Cleveland. Should I spell that right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Cool, just making sure. Right? So these are our 12 regional reserve banks here. Okay. New York City, Chicago, and San Francisco are considered to be kind of the big three, right? They're the elites here when it comes to the regional banks. And in fact, if you aggregated New York City, Chicago, and San Francisco's assets, it's about 50% of all the Fed's assets. Right, so about half of all the Fed's assets are located in New York City, Chicago, and San Francisco. Why? Well, of course, New York City, as we're going to talk about, it's at the financial head of the United States. Right, say what you want about it, but it is the financial and economic, really mecca of the United States. Chicago, as we've talked about earlier in the semester, is another huge market, but especially when it comes to commodities trading, right? A lot of commodities trading happens out of Chicago, and hence you have a lot of economic activity. San Francisco, it being on the West Coast, is the premier economic and financial center of again, the western side of the United States. So those three are extremely important. Now, the NYC Fed has some extra things about it that make it important. First off, it is a permanent seat, if you want to say, or it's always a voting member of the Federal Open Market Committee, the FOMC, that we're going to talk about. So we know that there's going to be 12 votes there. One of them is always the New York City Fed, right? The other regional bank presidents, we'll get to, but that one is always. Why? Because New York City is so important, right? If something's not going right economically in the United States, it's probably going to be solved in New York City. It's probably caused in New York City too, right? It's where the New York Stock Exchange is. It's where everything is happening, right? So that's one thing. It also has, I think it's over 100 billion. Yeah. It's around, like, over really, but around 100 billion, right? In gold, right? In the world's gold is located at the New York City Fed. It has the location of what's called the open market desk, which becomes important in the buying and selling of treasury bills, notes, and bonds. And a few other things, but these are the big ones, right? So the New York City Fed is specifically, I don't want to say powerful, but is a bit more important than the other ones, right? So we have these 12 regional banks. Now the question is, who owns these banks, right? Are they part of the federal government? They're not, right? The Philadelphia Fed has nothing to do with the federal government. It's actually by design. Are they owned by or run by the state government? No, they're not really done there either. What about the local government? Is it part of the Philadelphia government, right? No, they're not. And that's because the Fed Reserve regional banks are private institutions. Right? These are private institutions, okay? They are not owned by the government. They're not run by the government. And in fact, as I keep mentioning, they are specifically separate from the government, right? Monetary policy and Fed policy, by design, is meant to be independent of normal government processes, right? It has nothing to do with fiscal policy, has nothing to do with taxes or government spending, right? Implicitly, there's some connection, right? But explicitly, no. Their decisions are done separately. It has nothing to do with it. In fact, if it does seem to appear that government is having an effect on these policies, it can be very problematic, as we're going to find out. Okay, so we know that these are private institutions, but again, then who owns them, right? Then who owns these things? Well, it turns out that all 12 of these Fed regional banks, yes, they're private institutions, but who are they owned by? They're owned by what we call member banks. Oops, my bad. Right? They're owned by member banks. These are commercial, private banking institutions that buy stock in the Fed. It does pay about a 6% dividend. That's where it's capped at. And in all honesty, they're not making huge sums of money from it. In fact, from what I read, it usually just gets donated back to the institution. Like they're not worried about that. They're worried about more of having a say as to banking regulations and monetary policy within their region. To be a member bank owning one of these institutions, you have to be active. Again, there's certain criteria within that region's area. Okay. Now, how many of these banks are member banks in the United States? Well, it turns out that member banks are somewhere between 20 to around 30, depends, percent of all banks, of all U.S. banks. Right? And you say, wow, that doesn't seem like a lot. So you're saying about 70 to 80% of banks aren't involved in the Federal Reserve process? And the answer is, yeah, they're not. And the reason is because a lot of banks are much smaller than we think. We think of big banks all the time, and understandably so, right? Too big to fail. We talk about the TD banks and the Wells Fargo, and I even know the banks of Santander and all them, right? But it turns out that a lot of the banks that we see in the United States are quite small, right? They're really kind of small banks that maybe have 2 or 3 branches, right, in a local area or something like that, okay? So they may not have the capital to invest, right? So about 20 to 30% of banks are involved. Now, even though you have a small percentage of banks that actually buy into this, all banks are required to deal and follow the directives of the Fed. Had to do with the banking regulation back in the 1980s. Its name is not important. There was just early 1980s, all banks, no matter how big, no matter how small, have to deal with the Fed. They have to have what we're later going to call the Federal Reserve account, which helps guide monetary policy. But we'll get to the specifics of that later. Okay, so they're all owned by member banks. Now, each Federal Reserve regional bank, of course, has a president, right? There's a president that's elected. Right? A president is elected to these banks. And there are 9 directors. And this is the interesting part, right? There's 9 directors. Stop this from shaking a little bit. Okay. The first set deal with the banking industry. There's 3 directors that deal specifically from the banking industry and are considered to help guide these decisions, right? So there's 3 from, just say banking, right? They represent banking interests within this region, okay? Then we have 3 from industry, right? And what we mean by industry here is within that region. So take the Philly Fed, for example. Within the Philly Fed's region, which is more than just Philadelphia, of course. If you look at the map, it involves actually a good amount. Delaware, I think, in West Virginia or something. I could be wrong. But 3 from the industry within that area. So this would be some type of manufacturing or any kind of goods or services being produced in that area. 3 people are going to be elected to represent industry interests with what the Federal Reserve Regional Bank does. And then we get, let's put this over here. Then we get to the third, the last 3, which are 3 from what we can call public interest. Right? These are 3 directors that are coming in that are going to represent public interest. Okay? So, what's interesting about this is while directors from the 3 directors from A, the 3 directors from B are chosen by the member banks themselves, okay? These here that are to represent public interest are actually chosen by the Board of Governors. Told you this house is crazy. Anyway, so the Board of Governors, right, which we're going to talk about later, is essentially the government, right? The Board of Governors is essentially the government wing of the Federal Reserve. We'll get into what that means later. But the 3 that represent public interests are chosen by the Board of Governors, not the member banks themselves. Why is this important? Because remember that these 3 directors are there to represent, usually it's like directors of hospitals, it could be someone that's involved in some big charity organization or whatever. It's not industry. Like you wouldn't see, public interest being, for Philadelphia, like Jeffrey Lurie of the Eagles or something like that, right? It would be specifically something from a care, and it would be chosen outside of the member banks, which makes sense, right? So again, it's a private institution, but the government is still involved, right? The government is still kind of doing some checks and balances, which we would expect, right? Now, what do these federal regional banks actually do, right? We kind of know their setup. They have a president, and that president's going to come back later. They have directors, right? We know who owns them. The question is, what do they do? Well, they have a number of things. Right? One of the big things that they do is they set what we call discount rates, and issue discount loans. Now, what are these? Okay. Well, discount loans are ones that the Fed can lend to commercial banks. Again, you and I, as non-incorporated banks, again, general assumption here, as non-incorporated banks cannot get these loans. But if you are a state-chartered bank, you could petition the regional banks to actually get this loan. And the interest rate bearing on these discount loans are what we call discount rates. So discount loans are just loans from the Fed to commercial banks. Right? These are loans from Fed to commercial banks, and the interest rates bearing on them are the discount rates, right? These are the interest rates on these loans, okay? So it's one thing the Federal Regional Bank does, right, is they set these up, okay? Now, the other things that they do, I mean, they hire a lot of economists, and they do a lot of economic research. Right? They do a lot of economic research here, okay? Sorry, guys. That's going to keep happening, apparently. So, I got kids, I got dogs. They're going to be barking and running around. So the Federal Reserve, they hire a lot of economists. They do a lot of economic research for their own stuff, which we'll talk about later. But also, it's proprietary information. They sell it. So if you're ever wondering what you can do with an economic degree, if you're really good at econometrics and statistics, if you're really good at empirical economics, working with data analytics, then this is the place for you. Specifically macro. Micro is a bit different. It's a macro institution primarily, right? The other thing is five out of the 12 FOMC, the Federal Open Market Committee votes that we'll talk about later, come from the Federal Reserve, right? The 5 out of them come from these regional presidents, right? And they have a rotation system as to how this works, right? There's a rotation system. So it's not the same president of the same Fed, outside the New York City Fed, that is always making these votes, right? So, and there's some day-to-day functions. They clear checks, they do a bunch of economic research, they do some banking regulations, they set required reserves. But again, those are more day-to-day functions. The big things that they do is they set the discount rates, they issue the discount loans, and really is these votes on the Federal Open Market Committee that we're going to get to. All right, so that's essentially the regional banks. Now, let's talk about the more government part of this, which is the Board of Governors. Oops. Right? It's often called the BOG, which is located, not surprisingly, in Washington, D.C., right? It's an interesting looking building. It looks kind of creepy, to be honest with you. It's almost like no windows, it seems. But anyway, we have this thing called the Board of Governors. Again, this is kind of the government aspect of the Federal Reserve, right? There are 7 governors, right? They are appointed by the president. And of course, they have to be confirmed through the Senate and the Congress and all that, and they usually are. There's been a few cases. I mean, recently, I think it was Steve Moore and Herbert Kane. I think he tried to put in, and people said that's not going to happen. And rightfully so. You can make an argument for Stephen Moore, Hurricane wasn't going to make it. But anyway, so they're appointed by the president, and they're not all done at the same time, right? It's not like every administration they appoint and confirm 7 of them, because then you would have a massive shift in monetary policy that could be problematic, especially, again, if you're trying to keep an independence between the Federal Reserve and the U.S. government. You don't want so much change in control to happen under one administration. It doesn't matter if it's Trump, Obama, Clinton, Bush, whatever. It don't matter, right? We want an independence there. So it's kind of staggered, right? It's usually 2 every 4 years kind of thing. And they serve a certain number of years. They get a 14-year term. Okay, and it's a one-shot. If you retire, that's it, you're done. There was an issue back in the day that someone would retire like on their 13th year and then get appointed again for another 14 years. And they said, okay, we're not doing this anymore. This was done. Okay, so it's a 14-year term, and that is it. It's over, and you move on with your life. Okay, out of these 7 governors, one is chosen as chairperson. Okay. Chairperson has a lot of control and obviously gets a lot of media coverage, right? Whether it's Alan Greenspan, Paul Volcker, Bernanke, Yellen, and now we have Jerome Powell. It's a big deal, okay? They're appointed. They have God, I think it's like 4-year terms up to 3, right? So they get 3 terms, right? So they're 4-year terms, coinciding, of course, with the president, and they can have up to 3, right? Meaning there are special circumstances where the president, during a term, during that 4 years, may say, by the way, we're done with you, we want someone else. It's very hard to do that, and it's not just I don't like the person, right? There has to be significant reasons for it, and I mean, it's so extreme, it's probably not going to happen. Then again, who knows, right? So 4-year terms up to 3, and most of the time they go for that 12, right? It's very rare that gets broken up. I should say very rare, but it's slightly rare that it would be. I mean, Greenspan went, Bernanke went till he was done. Yellen, of course, went in for 4 years and then was replaced with Jerome Powell, and it is what it is. You could agree with that decision. You could disagree with it. It is what it is, though, right? So we have this chairperson. This chairperson holds a lot of power. They have to talk, or I shouldn't say really talk, they're not really talking. They have to answer questions to Congress twice a year to explain their decision making. And the chairperson has different characteristics, different styles, right? Greenspan was known to be, well, I should say even before Greenspan, you had Paul Volcker, who was very dry, very funny, liked to talk. Was a big fan of the cameras, you could say, and really didn't take a lot of ish, you know what I mean? And then you had Greenspan, who was a bit opposite, right? He was an economist, but more from the market than academia, which most are from academia, but not always. And he liked different types of data. He liked a lot of market data, a lot of confidence intervals to work with. He was not only non-transparent, he was anti-transparent. He didn't think that he should explain anything to anybody. It's none, you're not going to understand it, so why should I even try to explain to you the decisions of a large macro institution like the Fed? And he may have been right. I don't know how many people in the Senate and in the U.S. House of Representatives really understand how monetary economics does, like you guys will. But that was his point of view, and there were some positives and negatives. He didn't get everything right, didn't get everything wrong. But one of the agreed upon kind of effects of all this was this idea that the Fed is this kind of shadowy organization, right? That always, is not telling us what's going on and all this kind of stuff. And it did, have a bit of a pushback. So when you had Bernanke come in, Bernanke was more transparent. And I remember actually some people that I knew in the investment world that thought he was too transparent, right? That he talked too much. which may be true. I don't know. And then Yellen was an extension of Bernanke, and what we're seeing from Jerome Powell is another extension of that. They all kind of share the same philosophy of what the Fed should be doing, what it shouldn't be doing, and so on. So the chairperson is important, and they do guide the meetings and things like that, right? And the key thing is that these 7 governors, there's 6 plus the chairperson, make up automatically 7 of the 12 FOMC votes, right? Now, we saw the other 5 are coming from the federal regional banks, the presidents from the Federal Regional Bank. They pick 5 out of the 12. One is always the New York City Fed. And the other 7 are coming from this Board of Governors. Now, here's the interesting part. So we said that the Federal Reserve System is a private institution, which is technically true. But if the big decisions, as we're going to find out, are coming from this Federal Open Market Committee, right? And we're saying 7 out of the 12 are coming from the Board of Governors, which are appointed by the President, approved by the Senate. I mean, you're saying 7 out of 12, a clear majority, that decision is coming from government-appointed economists. The others are coming from private industry. So it would be incorrect to say that it's completely private. And it's also incorrect to say that it's completely part of the government. Private industry does have a say in this, but the government kind of has a bigger say. So it's interesting, right? But still, there is a distinction. There is a difference, right? So, that's the Board of Governors. Now, what does the Board of Governors do besides vote on the FOMC? Right? They review budgets, they review salaries, they hire economists, they do a lot of research as well. But really, their big thing is that there are these main voices, right? And again, they present their evidence to the government and things like that, right? So, that's the Board of Governors. Then we get to essentially what we said before was the Fed, right? And that's that Federal Open Market Committee, what's known as the FOMC, and again, essentially is what we call the Fed, right? When people refer to the Fed, increasing interest rates, decreasing interest rates, all that, they're talking about the Federal Open Market Committee, right? Now, they meet every 6 weeks. Every 6 weeks. Right? Every 6 weeks they meet. They have a meeting that's about 2 days. It starts on a Monday. There's a whole itinerary. You can look it up in the text. They present research. I hear they have amazing food. But they present the research. They debate. There's Q&As. Each federal regional bank is there. Pushes what's going on in their region, in their area, economically and financially. They propose what they think should happen. And then there's kind of a back and forth. There's a rapport, and they have different styles, right? The different presidents are, they all know each other, right? They have their entourage of economists, and they present all their findings, and they debate, and they go back and forth. And then the next day, on Tuesday, they have a little bit more, debate. They vote. They have lunch, and then by 2:30, or not 2:30, excuse me, by 2:15, always it seems on the dot, 2:15. They present what they are going to do. What are they going to do with what we call the federal funds rate, what we do with interest rates, what we're going to do with buying and selling of treasury bills, what is their projection to affect the rest of the economy, right? And that's what it does, right? So they meet every 6 weeks. Again, if we catalog those votes, right, there's 12 votes. One here is from the New York City Fed president. 4 are Fed regional banks, FRB presidents. Again, it's not. They have a system of rotation, right? There's no favorites here, right? There's a system of rotation here, right? And then we have the 7 from the Board of Governors, right? Okay, so that's where the votes come from. Okay. Now, what's interesting is they don't actually buy and sell the securities. They make the decision on how many treasury bills, notes, and bonds to buy and sell, but they don't actually do it. The actual selling comes from what's known as the open market desk. Which is located at the New York City Fed. But again, it's a separate, almost a separate institution. Like I said, decentralized, right? Numerous little institutions making one big one, right? So we have this open market desk located at the New York City Fed, and this is where all the buying and selling happens. The FOMC doesn't do it. They just do the directive, right? They issue out the directive. Okay? They issue out the directive of how much to buy and sell. That goes to the open market desk, and then they go through the whole process that we'll get to later that involves an auctioning system and all this really, really cool stuff about what happens, right? But this is what they do. Now, the chairperson is very important, as we said before, because they set the tone of these meetings, right? They're the ones that present who's going to talk, what kind of research we're looking at, you know. They kind of set things up, and again, they have styles, right? And people react to that, okay? So it's interesting to see how things change. They do take notes on them. What gets released and what doesn't get released, of course, is a matter of a little controversy and debate, but that's how it works, right? So all three systems are involved. The FOMC, makes the directive to the open market desk to buy and sell, located at the New York City Fed, but the votes are made up of these other two institutions. And we saw that the federal regional banks aren't exactly separate, right? The Board of Governors also has some connection there, right? And so they're all interconnected. It's not just one system. It's been decentralized into numerous systems that all have checks and balances. So now that we get a kind of understanding about how this works, we're going to look at how the Fed actually does what we call the money supply process, right? The actual buying and selling and how this all works and how this affects interest rates.